Hey, let's bring in an investor who has been taking risk off the table for several months now, and it's worked pretty well for him. He's Michael Vogelzang. He's the president and chief investment officer of Boston Advisors. He oversees $1.7 billion in assets. Michael, good to have you back here on Street Smart. You've been taking risk off in small chunks, and you've got your current defensive position. You put it in place about 5 weeks ago. Good call. Why did you do it then?
Well, as we talked about back then, the market and the environment for financial assets is simply getting more hostile. It's not that complicated. We've had a huge run, first of all, since last really September, ran through sort of March or April, and the market had gotten a little bit more expensive. There's a lot. It was very extended, and you've got the usual laundry list of things that are causing some angina around the economy. You nodded, you've got the ending of QE2. The uncertainty of what's going to happen next. You've got all the wrangling going on in Washington over the deficit. You've got Japan. You've got energy prices at $4 a gallon for gasoline. The housing market's hitting new lows. There's just all kinds of really negative news, and that environment we think is important, and particularly one of the bigger things, or one of the more important things, frankly, is the tightening of the financial interest rates overseas, particularly in the emerging markets. And that's beginning to slow those economies down, and those have been big drivers of our world. And so again, just sort of collectively, it appeared to us that the run had run its course.
I want to bring up actually something that economist Chris Lowe mentioned to us early, because you mentioned, Michael, you just talked about the emerging markets. He talked about that as well, and he really was trying to put a finger on the recent slowdown. Listen up, everyone.
The primary cause of the slowdown is higher gas prices, higher food prices. Those follow from overheating in the emerging markets. And the answer to that is emerging market policy, not U.S. monetary policy. And thankfully, all of the big emerging market economies are already tightening.
Michael, curious what you think about what Chris Lowe had to say here.
I think it's right on. They're tightening. They've got to slow down. They're increasing inflation rates. The problem is that's causing strength in the emerging market currencies. The U.S. dollar has been generally quite weak, to say the least, and so they're having a harder time exporting to us. So some of the engine for their growth is softening up. This is a fairly significant issue, and I think your guest was right on point. It's certainly one of the reasons why we've seen some slowdown in emerging market stocks. They've been underperforming for quite a while, actually.
Michael, another significant issue is about what happens in terms of QE, and we're all kind of speculating after we heard from Ben Bernanke. Sheila, I want to bring you in because you're looking at one argument why the end of QE2 doesn't necessarily mean the end of stocks, something that many folks have been worried about.
No, that's right. And look, Wall Street obviously dissecting every single word that Ben Bernanke was saying in his speech yesterday. One of the key takeaways that we're getting is that there's likely not going to be QE3. Brian Belsky, he's over at Oppenheimer. He's a chief market strategist there. He says, look, the end of QE2 may actually not mean the end of stocks. And what he's looking at is what's called the M2 money supply. So this basically takes a look at all the money that's out there in checking and savings accounts as well as U.S. public accounts there. What he points out is that there is plenty of money in the system. Liquidity is really not the issue. When you take a look at M2, you can see that they've tracked stocks quite nicely. There's more than enough liquidity in the system. Michael, I want to get your opinion on that. Is that an accurate indicator in terms of how stocks may or may not react with the end of QE2? Is there enough money in the system right now?
There's plenty of money in the system. I don't think M2 is particularly widely followed any longer. It's a bit of an old-style measure. Cash is a lot more than just checking accounts and savings accounts in the United States. M2 is a bit broader than that, but the point is the same. Cash is a global phenomenon, and at the end of the day, we've had incredibly easy monetary policy, which of course has driven stocks back up from their lows from 2 years ago. So that's really done its job. Much more importantly, I think, if you listen to Bernanke, our take on Bernanke's view is that he simply wants to keep deflation expectations away from this market. In fact, as far away from this market as you can possibly get. Every time he talks, he says inflation's better than deflation. We're going to get inflation. This is a guy who was named Helicopter Ben for dropping dollar bills over, out of a helicopter to stave off deflation. So this is very clearly what he's trying to accomplish. QE2 worked in that sense. Inflation expectations were raised. They're beginning to soften again. The question really is, how bad do things get, and what's his response? If we see unemployment spike back up, if we see real estate prices fall again, if we see the economy begin to roll over into a double dip, and bank lending not occurring, is he going to be forced to do something like QE3? And if that's the case, he's effectively signaled that that's still on the table, although the bar is raised pretty high.
Michael, let me ask you, you're speaking about inflation. I know you've been long gold. You're a fan. Silver has come way down. What's your view right now on silver? Do you buy this dip where it's come down 40% in about the past month?
Yeah, we've gotten a little more constructive on it. You know, we've owned it for a long time. We've made a lot of money on it. It clearly got significantly overheated, and we were sellers reasonably above $40. And so, you know, we trimmed our position way back. So we've got a small position. We're kind of analyzing it, waiting to see. I think the spike was so high that it's going to take a little while to burn off, and so we're not in any rush to get back into silver, but we'd be more constructive here than negative.
Michael, you are also more constructive on some of the defensive names. Suzanne, I want to bring you back in because you've been looking at some of those defensive groups.
Yeah, Carol, what we saw today, which is not unusual, is investors buy those staple stocks, in particular the food names like Kroger, Safeway, the grocery stores, also Hormel Foods. These companies saw gains of at least 1% today because there is so much uncertainty. But this is not unusual because all year long, investors have been buying the staples, and they've really been buying the healthcare stocks. Healthcare names are up 11%. Staples are up about 5% or so, and at the same token, they've been selling the cyclicals. Michael, I know you like healthcare and consumer staples. You're taking a more defensive approach. Do you like these groups for any other reasons besides they offer some safety in uncertain economic times?
Well, I think it's all about relative earnings growth, and you know, if we start to see a significant slowdown, the more cyclical companies are going to have a tougher time making money. And as a result, the 7, 8, 9, 10% of Procter & Gamble and some of these other more consistent growers is going to look a lot more attractive. That's sort of the fundamental story. You know, at the end of the day, though, the stock's going to move. Stocks are going to move based on investor sentiment. There's really a proxy for this row trade, this risk-on, risk-off trade. And you know, one of the frustrations for managers in this period has been, you know, when risk is on, that is the emerging markets global growth story is on, the stocks that are associated with that story move together. There's not a lot of discrimination. And frankly, the more conservative stuff, the late cycle stocks don't move much at all. And the schizophrenia in the market's been very, very clear. Either risk is on and you see the metals, the producers, the energy companies, you know, the industrials flying, or risk is off and those are heading down. And as you can see, staples have done very nicely. So we marked the bottom of that trade in really about late February. Staples and healthcare, utilities, and technology telecom began to outperform in late February, and they've been pretty much on a roll since then.
Michael, 20 seconds here. Got a viewer writing in, says, how long are you going to be a bear? When will you buy again? Do you view this as a short-term hiccup or a longer-term structural problem? Be just quickly if you could.
Yeah, you know, I don't think we're bearish. I don't think we're looking at a 20% downslide here. I think a lot of it's rotation in the market. You know, if we get through the summer and we're still in reasonable shape, maybe down another 5 or 10% from here, we'd probably get more constructive.
Going to leave it on that note. Michael, good to get your thoughts once again. Take care.
Thanks, Carol.
Michael Vogelzang, Chief Investment Officer over at Boston Advisors.